videos that buy and hold investing is almost impossible to stick to over the long run. We also saw how expensive it can be to invest based on our gut feeling or based on the news events. Now, let's consider the alternative. A numbers-based, objective, non-subjective, non-emotional strategy. First, what does that mean? Well, it means you have a predefined, well-articulated method by which you make your investment decisions. Simple. The decisions aren't based on our emotions or on our news events, but if the system is done right, it will take our emotions into account by not exposing us to extreme market declines. It gives us objective triggers, and we know that we have this system. And the system makes the investment decisions, and then it's easier for us not to pay attention to our emotions. So that's the theory. But you know what? There are problems with the systems-based investment approach. First, which system should we use? Is there any reason to think that one system is better than another? Look at this numbers-based investment strategy. This is one that's touted by a major financial institution. But it's flawed in my opinion. The major problem is that this system triggers too many changes too quickly. You can see that the last trigger to get out of the market was on February 8th, right before the market turned around. Then it triggered investors to get back in after the market had already recovered, missing some very good recovery days. Now look at the cumulative results. Sure, from 2005 they look pretty good. But if you examine this a bit closer, you see that actually they did far worse than even the buy and hold did since 2012. So it's not a good system. And we need a good way to determine if the system we're looking at has any proof of concept, some reason to believe that it's good for us. Next, is it good for you particularly? How much trading takes place? What are the worst historical losses? That's not a guarantee of the future, but it gives you an idea of how much volatility. How much time do you need to spend monitoring the system? And even if the system is good and it's a good fit for you, you have to realize that no system is right every time. That's important because it means that there will be signals that tell you to do something and then you have to reverse it very soon after. To make it worse, if you use a numbers-based investment method to guide your investments, you're going to always be late to the party. And here's what I mean by that. A numbers-based investment approach, it needs data over some period of time before it's going to provide any kind of signal. Now, look at the example above. In this case, it took a number of down days before the system kicked in and told you to do something different. So you already suffered losses before getting out of the market. And that's going to be the case with any method you use. And then just as you got out, the market turned around. And you missed out on those recovery days before the system told you to get back in. This happens because every numbers-based investment approach requires data, which in our case equates to time before it signals a reversal. Either moving from a hold to a sell or a sell to a buy. In short, no investment method has a crystal ball. You'll always sell later than the best time to sell, and you'll always buy later than the best time to buy. That goes with the territory. And another negative is that a numbers-based investment strategy may reduce some of your emotional anxiety associated with investing. But you know what? It won't get rid of all of your emotional response. You'll still face periods of fear. You'll be tempted to override the system. So with all those negatives, why even bother? Well, I'll show you two pictures that I think can explain it. Here's one, and here's the other. Despite all the imperfections, errors, and mistakes, using the strategy, a good one, even though it's imperfect, gives you the opportunity and possibility to potentially escape some of the damage of a market catastrophe, as we experienced in 2001 and 2008. while allowing you to hold on during difficult but temporary declines that happen almost every single year. That's the potential benefit. So we're going to look at the downsides of using an investment method and try to find one that minimizes the negatives and accentuates the positive in the next video.